Hello, I'm Professor Jaideep Sen, and I'm going to present our paper entitled Hierarchical Risk Parity and Minimum Variance Portfolio Design on Nifty 50 Stocks. This paper has been jointly authored by me along with our students Sidra Mehtab, Abhishek Datta, and Saikat Mandal. Before I start, I give a brief idea about the objective of the work. There are primarily two objectives. The primary objective of this work is to design and develop two robust portfolio approaches. One following the optimal risk portfolio approach along the line of the critical line algorithm, and the other is hierarchical risk parity algorithm on 8 critical sectors listed in the National Stock Exchange of India. The second contribution of this work has been robust backtesting method has been illustrated for evaluating the performance of the portfolios, taking into account, the risk, return, and Sharpe ratio of all the portfolios together, so that a very robust evaluation approach or the framework can be actually arrived at. The contributions are three. First, it presents two different methods of designing robust and efficient portfolios using critical line algorithm and hierarchical risk parity algorithm. And those portfolios are applied on 8 critical sectors of India. The sectors are listed in the National Stock Exchange of India, which is the largest stock exchange of India. And then the second contribution is development of a very robust backtesting method. And third, of course, is the return and risk evaluated in this work on the portfolios that we have developed, gives fair enough an idea about the current profitability and the volatilities of those sectors. So the outline of the work is as follows. We have got some little discussion on the related work. Then we have got the methodology description, then a brief description about the CLA and the HRP portfolios. And then we talk about the implementation details, performance results, critical analysis of those results, and then the conclusion and the references. Now, as portfolio design is intimately related to prediction of the future stock prices, there are three different strands in the literature on prediction of future stock prices. One is simple regression method. Second, basically, is the entire gamut of econometric method like ARIMA, Granger causality, auto regressive distributed lag, ARTL. And third strand basically encompasses all machine learning, deep learning, and natural language processing based methods. And portfolio design, of course, involves different techniques like multi-objective optimization, principal component analysis, meta-heuristics, and fuzzy logic, swarm intelligence, genetic algorithms, and so on. Now, following up the steps basically used in our methodology. First step involves choosing the sectors, and the 8 sectors that we have chosen from the NSE basically are these: auto, banking, fast moving consumer goods, FMCG, information technology, IT, metal, pharmaceuticals, realty, Nifty 50. And here we can mention that the Nifty 50 are that 50 stocks which are most critical in the Indian economy, which are chosen from different sectors. We'll see later down in the talk, which reflect the overall sentiment in the Indian market so far as the stock exchanges are concerned. So we have got data acquisition loading. This step actually involves automatic extraction of the historical prices of the stocks used in this work. We have chosen the period January 1, 2016 to December 31st, 2020 for the training of the portfolios, designing of the portfolios. And then the testing period has been chosen from January 1, 2021 to August 26, 2021, when the paper was actually completed. So you can say that 21, this is the testing period, and previous 5 years is the training period. Automatic extraction of the stock prices were done using Python libraries, using the ticker name and from the Yahoo Finance websites. Based on the historical prices, the returns and the volatilities historical of all these stocks were computed. And based on those historical returns and the volatilities, annual return and volatilities, we first designed the CLA portfolios, that is nothing but mean variance portfolios of Markovich. So the CLA portfolio is designed that maximizes the Sharpe ratio, the ratio of its return and risk. The portfolio optimizes the return and risk based on the estimated values in the future. So the CLA portfolio actually depends on a robust estimation of the future returns, which we'll see in the next slide. And then we went for designing the HRP portfolios, which are a very novel technique proposed by D. Prado, a very well-known financial expert actually in the world, who proposed actually some parity-based, risk parity-based approach of weight allocation to different stocks in a portfolio. So we actually implemented that, having some novel libraries in Python there. So that we can ultimately have that HRP portfolio realization on the stocks that we have analyzed on the 8 sectors. And after the HRP and CLA portfolio are designed, then those CLA and the HRP portfolios for all these 8 sectors are back tested. The back testing were done on 3 metrics, as I've said: cumulative return, annualized risk, and the Sharpe ratios. And the testing was done on both the training period as well as on the test period. Of course, the focus was mostly on the test period, because that is where the interest of the investors lies, how the portfolio is going to perform in the future, and how the investors can exploit the stock market to gain profit. Anyway, so the back testing has been done both on the training and the test data set. So these are the some small details about the 2 portfolio design. The CLA portfolio was designed using efficient frontier, first by generating 10,000 candidate portfolios, identifying the efficient frontier, and then finding the point which actually yields the highest Sharpe ratio, because the Sharpe ratio gives us an idea about the real usefulness of the portfolio, because it optimizes the return and risk. And while designing the Sharpe ratio computing, we took that portfolio with 1% volatility as the risk-free portfolio. On the other hand, design of the HRP portfolio involved actually 3 steps. First, there is an agglomerative clustering, which has a single linkage based matrix called word distance, on the basis of which the stocks are put into different clusters. And then there is a quasi-diagonalization approach, which basically transforms the correlation matrix of the stock returns in such a way that the more correlated stocks are put nearer to the diagonals. And once that step is over, then there is a recursive bisection approach, which basically allocates weights to stocks belonging to the same cluster in the proportion to the inverse of their variance. So higher the variance, lesser is the weight for a given stock, which is going to get in a given cluster. Okay, so implementations based on the report of the NSE released on July 38th. The 10 most significant stocks of the 7 important sectors and the NIFTY 50 stocks are identified, because every month there is a report released by NSE, and based on that, the top most influential stocks vary. So we based our analysis on the report released by NSE on the July 30th. Using the historical prices of the stocks from January 1, 2016 to December 31st, 2020, the portfolios were built using CLA and the HRP algorithms for the 8 sectors. This is the crux of the work. The portfolios are backtested in the training period January 1, 2016 to December 31st, 2020, and on the test data January 1, 2021 to August 26, 2021. The evaluation were based on 3 metrics: return, risk, Sharpe ratio, and the stock price data, both on the training and the test. And the models are built using Python libraries executed on the Google Colab GPU environment. So this is the results started getting from the slide onwards. So for the auto sector, this is the dendrogram of the agglomerative clustering that HRP algorithm created. So we can clearly see that there is one cluster here, another cluster here, and the cluster here, and the cluster here. 4 clusters perceptibly coming out, and this is the allocation of the weights. This is CLA, which looks much more skewed, and this is HRP, which is very, very uniform, and that is the strength of this what you say this particular approach. And it's supposed to work better on the out of sample data because of the more diversification that is achieves. And these are the 10 stocks in the auto sector which has been chosen based on the NSC's report. And this is the in sample, that means training period performance of the return of the CLA, which is basically the blue color line, and this yellow color line basically is the HRP, and this is the performance on the out of sample data, that means on the test period. And this is the final capture. The Sharpe ratios for the in sample CLA, it's 0.6977, whereas HRP is 6210. So we have got a higher Sharpe ratio for CLA, but that is over the in sample, that is during the training period, whereas during the test period, the HRP is 0.7468, 6641. So HRP clearly outperforms CLA in the out of sample data, which is the most important part. Although the performance of this sector is not that good because the Sharpe ratios are less than 1, which are not good indicator for prospective investor for this particular sector. Similarly, for the banking sector, if we look at, this is the dendrogram for the HRP. These are the allocation. Again, you can see there is a quite skewed, very high allocation to this particular stock, HDFC Bank, by CLA, whereas for this, it's much more uniform. Sharpe ratio with the out of sample data, again, we see the HRP has beaten CLA, whereas here CLA was better and the in sample record. So for FMCG, again, now that we know this is in sample return, this is out of sample return, this is allocation of the waste, this is the dendrogram. Let us focus on the Sharpe ratio of the out of sample record, which is the most important part. Again, we see HRP has outperformed CLA, and HRP has outperformed CLA over in the in sample records also. So for the IT sector, again, the HRP is marginally higher with a Sharpe ratio. HRP is higher on the Sharpe ratio in the in sample performance as well. On the metal sector, again, we see that HRP is higher in the out of sample as well as in sample. Similarly, for the pharmaceutical sector, HRP happens to be lower. This is the first one where we see that the HRP happens to be lower in the out of sample records in terms of the Sharpe ratio, whereas for in sample also it is lower. For realty sector, we have got in sample HRP, we can say almost equal here, but for the out of sample, HRP is clearly the winner. And finally, the NIFTY 50 stocks, where there are 50 stocks and it's a quite diversified portfolio. You can see that there are 3 big clusters which has been formed by HRP, and there are massively diversified portfolio created by HRP, but still there is a skewed portfolio created by CLA, and these are the performances where you can clearly see that HRP is winning over CLA in the terms of cumulative returns here as well. So we have got 2.2 HRP Sharpe ratio and 1.7 CLA Sharpe ratio. So let's now proceed to the observations. We see that in sample performance, CLA is better in 5 cases out of 8, whereas HRP is better 7 cases out of 8. And this is basically clear indication about HRP's superior performance over HRP's superior performance over CLA and the out of sample records. This is because of the higher diversification it achieves and the less reliance actually it has on the computation of the future estimated returns based on the correlation matrix, which becomes unstable due to presence of some correlated stocks, which is the problem with the CLA. And our analysis also, study also shows that. So in the conclusion, we have presented 8 important sectors of the Indian economy with CLA and HRP. Using the historical prices of the stocks over the period January 1, 2016 to December 31st, 2020, the portfolios are built and they were tested in the period January 1, 2021 to August 26, 2021. Portfolio yielding the higher Sharpe ratio for a sector is identified on both the training and the test data. However, the portfolio that actually performs better on the test data is recognized to be the superior one. It is observed that the CLA portfolio will get higher Sharpe ratio for 5 out of 8 sectors in the training set, whereas HRP outperformed its CLA counterpart of 7 sectors on the test data. As a future plan of our work, we want to involve hierarchical equal risk contribution portfolio and the optimum risk portfolio, maximizing Sharpe ratio. All these will be identified on the Indian stocks as well as in the global stocks. These are the references, and this is the time for any questions that you have. Thank you very much for your attention.